5 months into the coronavirus pandemic and a nationwide lockdown, the economic activity is yet to get back to normal. Mobility continues to remain restricted, and economic activity continues to remain limited, as some of the sectors are still not allowed to open up due to the fear of the virus. The impact of this disruption will be captured in the GDP. Hello and welcome to Liveman. This is Shreya Nandi, and you are watching Liveman's special coverage on the Q1 GDP data that will be released today by the government. Today we have with us Dr. Devendra Pant, Chief Economist at India Ratings. Thanks for joining us, sir. So I would first like to start by asking you that everybody is expecting a contraction in this particular quarter. So if you could just take us through what to expect and what are the means behind a sharp contraction.
Yeah, the contraction is inevitable, and there are various estimates. Initially, when the lockdown started, everyone was expecting like it will be 2-week, 3-week lockdown. Post that the things will start coming to normalcy gradually. Unfortunately, that didn't happen. We had, as Oxford University, who has classified a lockdown across the globe, the lockdown in India is the severest lockdown which anywhere in this world we had seen. So economic activities in the month of April and to large part of May was totally standstill. Only your essentials were allowed. And what has happened is, to begin with, in the first 2 weeks or 3 weeks, there was severe restriction, even the movement of essential goods, because at the toll barrier and the policeman, they didn't have the list what is essential, what is non-essential. And we were seeing some supply shortages, which thankfully post third week or fourth week started easing out. So April and May, April was totally washed out. May something started, government offices, government started functioning. Essentials were functioning, but even non-essential government services started working. June there's still some relaxation, but what we had seen initially the virus or the spread was mainly limited to the urban metros where the mobility is because of trade or tourism linkages were high. But as the migrant population moved out from the urban areas to the rural area, and if we look at the way the different zero results are coming, which is giving indication that 57% in Mumbai slums, 29% in Delhi are already have the antibodies within themselves. So basically, the virus spread is much deeper than what the headline numbers of virus spreads we get every day. What did it mean? Severe production shutdowns, and B, the supply side disruptions. If you look at whether you look at the Google mobility report, whether you look at the Apple mobility report, and the new index which is now has come, which is called the TomTom index, which measures your how much is the traffic congestion in the cities. So what is happening is, if you look at the Google mobility, because that is by far the most tracked indicator, and you can get that at the state level, at all India level. So what we had seen in April, the mobility was somewhere around minus 70% or so. They improved, but what has happened is the improvement in after June has plateaued out. So the mobility, whether we look at the mobility, whether we look at the consumption of petroleum products, whether we look at other your power, daily power production, which is same as the daily power consumption. Those numbers in the month of July plateaued out at the level similar to the June. There is, if you look at again the mobility indicators, again, August is showing minor improvement, but the improvement is not very different from where they were in these indicators in the month of June and July. So the first quarter, we are expecting a contraction of 17% on YOY basis. And post that, as things will start opening up, because what is happening is we have an unlock one already started, I think month of June or so. But since the way the virus has spread, There has been the regional lockdowns. There has been the regional shutdowns. So today morning I was reading that Jharkhand has extended lockdown till end of September. Many states will take a call between now and end of the month by Monday, how they will continue, whether it will be all state, pan state, or is it just in the your main containment zones.
Okay, so that's a pretty big number that you've just said. It's like a minus 17%, dip in, economic growth. But so, like you said, that there has been, there have been lockdown in certain part of the countries, and the economy is yet to open up completely. So, going ahead, how do you see the performance in Q2 and Q3? Do you see a similar trend on a trend similar to Q1, or there could be some respite?
The way things are shaping up, and if you look at even the globally, the lead indicators are showing some improvement in the Q2 and internationally the Q3 on calendar year basis. We believe the Q1 is the bottom of the pit. Hope that it is bottom of the pit because nobody is able to have a handle on it. Partly because the data, and partly because there is no parallel of this kind of situation. Only parallel we can have is Spanish flu in 1918, and within a span of 102 years, the things have changed. Say, for example, entire financial sector is working seamlessly. We have been working from home since 22nd of March, but the extent of work, intensity of work, quantum of work, and has remained same as we were doing working from home. When we were working from the office. So there are these kind of examples. Say, for example, the media is working, all right? So you guys are printing newspaper day in and day out. You are putting stories on the web, whether working from home, on field, off field, whatever. So we believe the first quarter of this fiscal, that's the bottom, and post that the things will start gradually. Mind you, gradually. It is not, though it may give you a false impression of a V-shaped kind of recovery, but it will be rather than the V-shape, it will be tick mark. So when you put when you and I used to give exam in the school and teacher used to put a tick mark, right, for correct answer. So you see, it comes down sharply and then gradually it moves up. As of now, our estimate is all 4 quarters of this fiscal will experience a negative YOY growth, year-on-year growth, negative growth. So basically, if we take the pre-COVID level as January, March 2020, which is the 4th quarter of last fiscal, the economic activity, even in the 4th quarter of this fiscal, which is January, March 2021, will not come back to the same level. So the size of economy is contracting because of this negative growth, huge negative, which as of now we are at the minus 5.3. Because of that base going down, we will see a bump up in the next fiscal. So the next fiscal is going to give you a number which as of now our estimate is somewhere around between 5 to 6%. But this 5 to 6% will be an optical growth because this 5 to 6% growth is coming on the back of minus 5.3. So it is it is unlikely that size of the economy even in the next fiscal will be significantly different from the size of economy in the previous fiscal. So April, March 2020 and April, March 2022, if we compare, then the size of the economy is unlikely to be significantly different from each other.
So that's a very, very, I think, significant and an important point that you said and rightly pointed out. Also, sir, as you also pointed out that various economists, various experts have been talking about a V-shaped or a W-shaped or a different kinds of U-shaped, different kinds of recovery. If you could give us a little more insight on why is there so much variation on the estimate or growth estimate for this fiscal and going ahead. Also, this is also being said that for as far as economists are concerned, it's because of the pandemic, it has been difficult for them to get a hold of the data, and calculating and estimating growth projections has been very difficult. So, if you could also throw some light on that.
Look, whenever we make an estimate, whenever we forecast, it is based on the past trend. You fit a model, you fit an equation which gives you a best result based on the current scenario, how much your model is able to explain. So say, for example, if I'm looking at last 20-year data, whether I'm able to explain 90% of the variation in that data, or whether I'm able to explain 95% variation of the data. You and I, using the same data set, the model which you have fit, you are able to explain 95% variation, and the model which I have fit, I'm using, I'm able to express 90%, explain 90% variation. Just because of these two, when we go down, when we forecast for next 2 year, 3 year, 1 year, or whatever time period, there will be divergence in your estimate and my estimate. So this is point number one. The point number two, if in the sample which we are using for our estimation, we haven't seen this kind of scenario. So your model, my model, and everybody's model is not capturing the impact of pandemic or related things in their estimation. The last, even if we take the SARS coincided with the global financial crisis. And if you look, it was very limited to certain pockets across the globe. And globally, there was not an impact. Now, if you see, name any economy other than China, the latest IMF result shows other than China, no other economy is going to grow this year, or major economy. It may be small size economies. All right. So the pandemic impact is across the globe, across the economies. You will find the trade contracting and all those. Now, when we don't have the data, we don't have any estimation to rely on, it will all subject to what assumption you are making and what assumptions I am making, or what assumptions any other analyst is making. Based on that, it will. The biggest assumption in this, when everybody started giving forecasts for this fiscal in the month of April and March, everybody's assumption was, or most of it, the assumption was by May or June that this will be controlled, and after that will start gradually improving. As economy will open up, we will see this thing happening. But as things started unfolding, and that's why as things are unfolding, because it is neither in your hand nor in my hand. So as long as, until we are not able to have a vaccine, right, and people are vaccinated, or we developed a herd or community immunity, for which nearly 60% or 50 to 60% population has to have antibodies. So basically, what does it say? We are affected by COVID-19, but our body internal strength was such that we came out of it and we have the antibodies, which as of now is being shown in the Mumbai slums, where we have antibodies were up to 57%. Until that happens, your assumption, my assumption will differ. Your assumption, my assumption differing means there is difference in the estimate. This is a simple term, simple language in English one can say, rather than giving up complicated terms, economic terms, and explaining it.
I think that I'm sure this explanation is going to give a lot of clarity to our to our viewers. Also, sir, now that we are coming to the festive season, do you see some kind of a respite or some sort of measures coming in from the government side to boost demand?
The demand boosting measures was need of the hour even in last fiscal also. But unfortunately, what we had seen, what had come up from the government side, is mainly the supply side response. Right now, we are looking at a situation where job losses, even if the jobs are secured, the salary cuts. I think there'll be few lucky, like our organization, where we haven't faced any salary cuts, and we even honored whatever the job offers our firm has made to the people before the lockdown. So we have honored all job offers. There is no salary cuts. Even the government sector employees are subject to no increase in DA. So they are also seeing the salary freeze. Now, job losses, salary freeze, economy not growing, simply say if what is the nominal GVA growth? Nominal GVA is nothing but the EBITDA plus wages. So the EBITDA is going to owners of capital, wages are going to owners of labor. Now both of them are affected. So there's severe demand squeeze. Now the problem with the government is right now, they didn't had any fiscal space even earlier. And now after this pandemic, that it has shrunk so much. So what we had estimated, even when they came out with the 3.5% fiscal deficit target, that was more on the basis of some optimistic revenue assumptions, because even at that time the arithmetic was not up to the mark. And what we are looking at 7.6% as the fiscal deficit of the center alone. We are looking at states deficit is somewhere closer to 4.5% of the GDP or so. So we are looking at a situation more than 12% gross market borrowing by the center and state governments. How it is going to be funded? There may be something, but ultimately the demand is going to come back only when you offer the jobs, when the jobs are created, and that even at this point of time, because you can create some jobs in your rural area by MNREGS, and simply assume unskilled labor moving from the urban areas to the rural area. In the rural areas, he is getting 202 rupee per day, which is subject to 100 days. So basically, one can say 4 months. In the urban areas, the minimum wages unskilled labor was getting, that was 350 rupees. So 148 rupee difference. Even if all the people, those who have migrated from the urban areas to the rural areas, find job in your MNREGS, will have 148 rupee per day less than what they will get at in urban areas. And in urban areas, it is generally, it has seen like there are no estimates that the most of the people will find some job or the other, and they will be able to earn 300, 400 rupee a day if somebody wants to work. So that is the challenge. So yes, need of the hour is government, and that to the central government, because the state government has limited capacity to borrow. Their borrowing cost goes up. The moment they go for borrowing. Center being the best borrower, and they will get that money and borrow it and pass it on the state. These are unusual times, and during unusual times, if we have to deviate from some of the usual measures, like center will not fund or center will not borrow and give it to the states for deficit financing. At this point of time, these kind of steps are required. So I think the center should borrow, give it to the states, and once the normalcy comes, then they can go back to the old situation of state governments borrowing themselves for financing of their debts.
And also, sir, going ahead, What key sectors do you think will be the focus area for the government? Like right now, in May, when the government came up with some measures under the Atmanirbhar package, we saw that immediate measures were for the poor, for the farmers, and for the MSMEs. But going ahead, what do you think are the key sectors that will be on focus?
Look, there are certain sectors which have, you can say, they don't see any light at the end of the tunnel for even next 6 months or 6 to 9 months. So early as these sectors can come up will be somewhere in the first quarter or second quarter of next year. These are all hospitality related sector, tourism, hotels, restaurant, and all. There is pharma is showing good spark. So whether we are able to do, some of the pharma companies are able to do your in-house vaccine, or whether they can do the generic for them for the global players. Unfortunately, though RBI has been doing a lot of liquidity measures, lot of interest rate cut and all those, unfortunately, at a time when the people's jobs are not secured, wages are reducing. I don't know how much that will boost demand. What we believe, because if you look at, we are used to looking economy from either from the production side or from the expenditure side. But there is another way of looking economy from the institution side. And when you look at the economy from the institution side, you have general government, which is central and state government, etc. You have public corporation or public sector enterprises, you have private corporations, and then you have the households. Households is the biggest among all. In terms of gross value addition, it is closer to 43%. Their contributions to savings is 58%. Their contribution to investment is highest at 38% or so. Now these are proportions are average for the year FY20 to FY19, for which the data is available. Now it is the household sectors. Household sector is what? All that MSME, unregistered, unorganized, not-for-profit institutions, etc., etc. And we have to do something for this sector, because this is the only sector which has this positive saving investment gap, and its positive saving investment gap finance negative saving investment gap of other three sectors. Now, if this sector improves, what is going to happen? Supply, the savings will go up, the gross value addition will go up, wages will go up, and demand will come back. And if we see since FY12 till date, this sector is gradually going down. Now again, one more optical number will come up, which will give us give a situation when people say, our situation is very good. You are going to see first quarter current account surplus, a big number closer to $18 billion. All right. Now that is a very sad situation for the economy like India, who is capital starved economy, where investment requirements are huge. At the time of falling savings rate, having a current account surplus means whatever savings we are generating in the economy, we are not able to invest that. And that will be again is not an ideal situation or an ideal outcome. Savings will rise, no doubt, because all those who have a stable job, they are getting salary, the expenditures are less than what they used to spend a year back. See, for example, in last 5 months, I haven't filled up tank of my car. So which I used to fill up thrice or 4 times a month. So that way savings will increase, but the amount of increase in the current account or current account surplus of that magnitude is mainly because investments are not taking place. No demand, so no private sector company will invest. So government has to do, they have to invest in the sectors which can crowd in private investment. Sectors which can crowd in private investments are all infrastructure sector, your agriculture, right? So the agriculture, what will happen, you have the dams, canal and other things. The farm mechanization will go up. Your tractor sales will increase. Your other farm activities will increase. You have investment in infrastructure, roads, ports, bridges, etc., etc. Right now, because of lockdown, the mobility is constrained, but the mobility will increase. The moment mobility increases, you can see that even the rural areas, those are closer to the urban areas, 50 kilometer, 100 kilometer, as people in Delhi, Mumbai used to travel, is 80 kilometer, 100 kilometer every day. The people even in the urban areas are coming. In Delhi, a lot of people are coming from the neighboring UP and Haryana. The moment you provide that all-weather connectivity, the mobility increases, and that always have a favorable impact on the income of the household.
That's again a very important point that you made. So infrastructure creation and job creation, these are the two key factors that we would see in the future that would lead to some sort of an economic revival. Thank you so much for your for valuable time and for your views, sir. As far as the viewers are concerned, stay tuned to lifeman.com for for live updates of the GDP numbers that will be released in the evening. Thank you.